Let's see in this video if XLM coin is ready to take flight. But please watch until the end so you don't miss anything. A downtrend from the top is usually the result of prices reaching highs at a certain point and starting to move downwards. This type of trend often signals a situation where the market is under increased selling pressure, and prices tend to make a downward correction. As prices move within this downtrend, they are likely to encounter resistance at certain levels. These resistances usually form the upper boundary of the trend, and when prices break through these levels, it indicates that the trend has been broken and a change in direction is possible. If prices break these resistance levels, a new uptrend may begin in the market. If this downtrend is broken, XLM coin will take off. But don't be so sure right away. Other metrics need to be examined, so keep watching. A bullish order block, located just below the price, is usually considered a strong buy zone. Order blocks are areas where there are large buy or sell orders at certain price levels, and prices react strongly when they hit these levels. A bullish order block is where prices experience a decline, and then buyers enter the market when this level is reached. Buyer pressure increases at these levels because these points were previously considered a great buying opportunity and prices reacted to them. If the price falls just below this bull order block, buyers are likely to re-engage, which could lead to an upward price move. If you want to buy, you can wait for this order block to move above it. A bearish order block on the upper side represents an area where the price had previously reached a certain level before sellers entered the market strongly and drove the price lower. Bearish order blocks are generally considered to be areas with strong selling pressure. At these levels, sellers step in when the price is rising, often causing the price to fall. A bear order block marks an area where prices are experiencing an increase, but this increase may be short-lived because sellers become active at these levels. This prevents the upward movement of prices and usually causes a retracement or downtrend. If the price approaches this bearish order block, sellers' pressure may increase, and prices may move downwards from this zone. And the price may break the trend and come back for a retest, and break the bear order block on the second attempt. In Elliott wave theory, when the first and second waves are completed, the third wave is usually the strongest and longest. This wave determines the overall direction of the market and attracts the attention of a wide range of investors. If the third wave targets the minimum Fibonacci level of 1,618, the price action will be strong and sustained. Reaching this level indicates that there is a great deal of buying pressure in the market, investors' confidence is growing, and most traders are moving to take positions at this stage. And 1,618 is the first and minimum point where the price may break out higher, and the third wave comes when no one expects it. The descending wedge pattern is an important structure in technical analysis and usually refers to a situation where prices are squeezed into a narrow range, followed by a strong breakout. This pattern indicates that the market is experiencing indecision at a certain point, usually in the middle of a downtrend. Over time, the price action becomes more and more squeezed into a narrow range, leading to a support and resistance level becoming evident. At this point, there is a power struggle between buyers and sellers, and the market is forced to make a decision. The descending wedge pattern basically consists of two main trend lines, an upper trend line and a lower trend line. The upper trend line is a line connecting the peaks of the prices and often acts as a resistance level. The lower trend line is the line connecting the lows of the prices and represents the support level. These lines lead the prices to enter a narrowing triangle structure, which symbolizes a period of uncertainty when the market experiences a lot of changes in direction. This pattern should be watched very carefully when approaching a breakout point. The descending wedge usually appears at a stage when the market continues to move in a bearish direction, but this pattern signals a strong upward movement afterwards. To be bullish, the pattern needs to break its upper line and then retest it. After that, it is ready to take flight. Descending channel structure. In the current situation, the fact that the price has touched the middle band indicates that it has reached an equilibrium point inside the channel. The middle band is a kind of transition point between the lower and upper boundaries of the descending channel, where the price is trying to find equilibrium. This point marks a kind of indecision between buyers and sellers. The middle band can act as both a resistance and support point, as the price can start moving up or down from this zone. Price action. Touching the middle band can often be indicative of a potential breakout. If the price stays at this level, it symbolizes indecision and waiting in the market. If the price breaks downwards from this band, it means that a move towards the lower boundary of the descending channel may begin. This would signal the continuation of the downtrend, and the market may come under further selling pressure. If it can break the middle band in one go, it will try the upper band this time. And if it can break the upper band, it will move to the high. The Bollinger Band is a powerful tool used to measure the volatility of the price and is often used to identify trading opportunities. Currently, the fact that the price is touching the upper Bollinger Band means that the price has high volatility and is possibly entering overbought territory. Approaching the upper band indicates that the current momentum of the price is strong, but it also increases the chances of a correction or pullback. This type of situation can often signal that an equilibrium point is approaching in the market, or that the price will find equilibrium by pulling back a little. If the price pulls back to the mid-band, it will be very healthy. And then it can go back to the upper band. The MACD indicator is often used to determine the strength and direction of the trend, but it can also indicate possible turning points of the market. A crossover of the MACD from the lower side upwards is a particularly important signal, often signaling the beginning of an uptrend or that it will gain momentum. This crossover is a move indicated by the interaction between the MACD line and the signal line, indicating that the momentum in the market favors buyers and that prices are trending upwards. A crossover of the MACD from the lower side upwards is often referred to as a bullish crossover and is considered a strong buy signal. This indicates that the market is starting to break out of the previous bearish trend and buyers are becoming dominant in the market. This crossover usually marks a period when prices end the uncertainty and correction before moving higher. If the cross is supported by a large volume, this makes the buy signal even stronger. Traders can take such a crossover as an opportunity for prices to move higher. This type of MACD cross not only expects prices to rise in the short term, but also signals a continuation of the current trend. However, there is always one point to be aware of. A crossover does not always guarantee a long-lasting rise. It can be a short-term move, and the price can quickly pull back after the cross. But if this intersection can break above the zero line, then we could see a prolonged and fast-rising price action. The RSI indicator is a momentum indicator used to determine whether prices are overbought or oversold. And a break of the downtrend in the RSI usually means a strong momentum change. Such a breakout can be a signal for prices to go higher, as it indicates that the selling pressure in the market is starting to subside, and buyers are gaining more control over the market. However, the fact that there was no retest after the breakout can also introduce a certain level of uncertainty. That is, even if prices break the trend line and move towards a new level, the reliability could be questioned as there is no test to see if the move will be sustained. After the retest, the RSI may increase so that the price will increase after the retest along with the RSI. The vortex indicator is an indicator used to determine the trend direction of the market and is particularly effective in detecting trend reversal points. And now the blue line has crossed the red and moved to the top. Such a crossover is often considered a bullish signal, indicating that buyers are starting to gain more control over the market. In particular, if price action supports this crossover and an increase in volume is seen, this could signal that the bullish move could be stronger and more sustainable. An upward crossing of the blue line on the vortex indicator is usually an indication that the trend is changing direction or that the uptrend is gaining momentum. This indicates that prices have the potential to move higher and is an important signal to attract traders' attention. And the higher the blue line can go, the higher the price will go. When we look at the 200 EMA, it has not been able to rise above the price for a long time. And if it can come out, and if it manages to be permanent, it can establish a long-term uptrend. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.